If you are holding stocks going into Monday morning, you need to prepare. Weekend turmoil in the Middle East has set the stage for major indices plunging into the red the moment the opening bell rings. The market closed on Friday fully expecting a grueling 14-hour peace negotiation to succeed. Instead, those diplomatic talks collapsed entirely. The confirmation came directly from J.D. Vance, whose official statements signaled that the extended diplomatic efforts had hit a wall. This failure triggered immediate aggressive posturing. We are seeing hardline rhetoric from Benjamin Netanyahu and threats from Donald Trump to blockade critical international trade routes. When politicians walk away from the table, market stability dies. Geopolitical frustration thousands of miles away is now translating into measurable financial risk for your portfolio. This chart shows the first domino falling over the weekend. Because oil continues to trade on international exchanges while equities are closed, we saw an immediate 5 to 6% spike in global oil prices. For the Indian market, centered here at the Bombay Stock Exchange, that rising cost of energy represents a direct threat to domestic supply chains. We are staring down a severe knee-jerk reaction. Major indices like the Nifty and Sensex are projected to open with a massive gap down, potentially shedding 2 to 3% right at the start of trade. Oil is the lifeblood of global industry. When its price violently spikes, the stock market is forced to instantly price in the fear of sudden, widespread inflation. The conflict has moved beyond diplomatic posturing. We are seeing eye for an eye warnings explicitly targeting the physical infrastructure of international supply routes. The ultimate target is the Strait of Hormuz. It is a narrow geographic choke point where a massive percentage of the world's daily oil trade is currently bottlenecked. A naval blockade here creates an instant energy deficit that throttles the industrial capacity of massive economies like China, Europe, and India. Global equity markets crash because strangling this specific geographic artery guarantees a global economic slowdown. Traditional stock exchanges close on the weekend, but capital never stops moving. Hyper-liquid 24/7 cryptocurrency markets act as our earliest warning siren for geopolitical shocks. Take a look at this dual-axis chart. While oil prices shoot upward on the news of the failed deal, you can see major digital assets like Ethereum taking a sharp dive. This weekend data allows the market to digest the shock and discover new price levels before the first stock is even traded on Monday. By the time the opening bell finally rings for traditional equities, the smart money has already used these weekend signals to adjust their exposure, so the market opens deep in the red. But you have to ask yourself, is this a genuine collapse or a calculated trap? Data from previous volatility spikes suggests that foreign institutional investors, or FIIs, often use retail panic as cover to execute short covering, buying back their positions while prices are depressed. Watch the chart gap down to a new low. At maximum fear, the volume indicator spikes as institutions buy back shorts at a discount. This buying forces a sharp recovery, leaving a long lower wick, trapping retail investors who sold at the bottom. Institutional money routinely leverages these windows to flip positions, while retail sentiment is at its lowest point. History shows a cycle where aggression increases until one side feels the economic heat and returns to the table. Donald Trump's frustration with election polling creates a narrow window where aggressive trade threats are often used as high-stakes leverage rather than permanent policy. This is why you look for technical safety nets. Indices like the Nifty have proven support levels, particularly around the 23,400 mark, where selling pressure has historically exhausted itself, creates the noise, but price action dictates the truth. The smartest investors ignore the panic and buy the volatility.